Welcome to the deep dive. Today, we're jumping straight into something practical, systematic investing. We're looking at a specific strategy, sometimes called the Piglet portfolio, especially it's set up for 2025. It's really aimed at, new investors or people who just don't have hours to track markets, the big idea, helping you reach retirement goals.
Right. And it does that by targeting the stock market's long-term average return. You often hear that number, around 10% annually. It's about discipline, not stock-picking wizardry.
Okay, so what makes this one stand out? Is it just buy and hold?
Well, yes and no. The core is long-term, almost brainless investing. And brainless doesn't mean the investor isn't smart, right? It means the system is set up beforehand, takes the day-to-day decisions off your plate, set it, let it run, and, it seems to work. Last year, the return was apparently 23%.
23%. Okay, that's pretty impressive for a set-it-and-forget-it approach.
Yeah.
So let's get into it. How does this system actually make investing, brainless? What are the mechanics?
Okay, first pillar, how you put money in. It uses dollar cost averaging, or DCA. The source calls it the piggy's market entry method. It's really straightforward. It tackles that big, paralyzing question, when do I buy?
Yeah. Trying to time the bottom. Everyone wants to. Nobody really can consistently. So DCA is just invest the same cash amount regularly.
Exactly. Fixed amount, fixed schedule, say the 1st and 15th of every month. You buy the target ETFs at whatever the price is that day.
Right. So if the price is low, your cash buys more shares.
Precisely. And if the price is high, you buy fewer shares. The cash amount stays constant. That's the discipline. It lets you, as they put it, go to bed early.
Right.
No need to obsess over whether it's a bull or bear market that day. You just follow the plan.
Time becomes your friend then, supposedly.
It has to be. That's why the commitment needs to be long-term. Generally, think 5 years, absolutely no less than 3.
But sticking to it when everything's crashing, that takes nerve.
It does, but the long-term data helps. Look at broad market ETFs like VOO tracking the S&P 500. The source mentioned an 80% return over 5 years. Even the riskier parts, like a Bitcoin holding, they included, up over 130% in 3 years. It's that consistency over time, the averaging, that builds the wealth.
Okay, DCA handles when to buy.
That's it.
But you mentioned emotion. We humans.
Yeah.
We tend to mess things up, right? Buy high, sell low. The classic mistake.
Exactly. We're sentient animals, as the source puts it. We react, often irrationally. Fear and greed are powerful drivers. When things are soaring, FOMO kicks in.
Fear of missing out. Yeah.
And when they're tanking, panic sets in. Sell. Get out. So the second pillar is designed to fight that automated rebalancing.
Rebalancing. So forcing yourself to do the opposite.
Pretty much. Systematically forcing buy low, sell high.
How does that work in practice? It sounds psychologically difficult selling your winners.
It can be. But the system dictates it. You review your portfolio periodically, maybe every few months, maybe twice a year. And you look at the proportions. Let's say U.S. stocks were meant to be 50% of your portfolio, but they've had a great run, and now they're like 70%.
Right. Way overweight.
The system says, sell that excess 20%, lock in those gains, and then immediately take that cash and buy whatever's lagging, the assets that are cheaper or haven't performed as well.
So you're trimming the winners and adding to the losers, essentially.
That's the discipline. It forces profit-taking and reinvestment into undervalued areas.
Was there a specific example of this in action?
Yeah, they mentioned last December, the U.S. stock market hit an all-time high. Emotion says, hold on, it's going higher.
Yeah, classic feeling.
But the system triggered a rebalance. Sell some of those high-flying stocks, and what did they buy? Bonds, because bond prices were falling at that time.
Interesting. Buying the dip in bonds using profits from stocks.
Exactly. The system made the rational choice, overriding potential emotion.
Okay, so we have DCA for entry, rebalancing for discipline. That brings us to step 3. What do you actually buy? The assets. The source lists 5 main types: U.S. stocks, global stocks, bonds, gold, and crypto. But before we get into the specific funds, there's a crucial adjustment factor, right? Based on the investor.
Absolutely fundamental. Risk tolerance. It's not one size fits all. There's a simple rule of thumb provided. 100 minus your age.
100 minus age. Okay, so if I'm 30...
then 70% of your portfolio could potentially be in higher risk assets.
And if I'm, say, 60?
Then it's 40% in higher risk assets, more towards stable, lower risk stuff. It automatically dials down the risk as you get closer to needing the money.
Because younger people have more time to recover from downturns. Makes sense.
Time is your biggest asset when you're young.
Now, for the 2025 specifics, you mentioned this portfolio isn't just a standard 60-40 stocks bonds mix this year. There was a manual tweak based on the economy.
That's right. A significant one. driven by macroeconomics, specifically uncertainty around the Federal Reserve. Remember, early this year, everyone expected, what, 4 rate cuts? Maybe more.
Yeah, that was the talk.
Well, that's shifted. A lot. Now maybe 2 cuts. Max. And even Fed officials seem all over the place. Some say 1, some were still hinting at 5 not long ago. It's uncertain.
Yeah. Plus, inflation is proving sticky. The Fed bumped its forecast up to 2.5%.
Correct. So putting that together, strong economy, higher inflation forecasts, murky rate path. The analysis concluded that traditional bonds and maybe some foreign currencies might not do so well. So the big move for 2025, manually cutting back the overall bond allocation compared to a typical balanced model.
Okay, that's a key insight. Less reliance on bonds this year due to the macro picture.
It's a departure from the standard playbook, definitely.
So let's break down the actual assets for 2025, maybe using that middle ground balanced investor profile, like 50-50 risk using the age formula. The source breaks it into 3 risk buckets.
Yeah, ordinary risk, high risk, and defensive assets. For a balanced portfolio, ordinary risk is the biggest chunk, 60%.
60%. What's in there?
This is your core, broad market exposure. Think U.S. stocks mainly. So ETFs tracking the S&P 500, like VOO, that gets 25% allocation. And then NASDAQ 100, like QQQ, that's another 22%. Big tech focus there.
Okay, so almost half the portfolio in just those 2 broad U.S. indexes.
Yeah, they're the engine. Then there are a few others for diversification within that 60%. Things like ESGU, which tracks socially responsible companies. It did well last year, apparently up 24%. HDV for high dividend stocks, things like energy, healthcare, pays about 3.7% interest. And XLP, consumer staples, companies like Walmart, Costco, P&G, stuff people buy regardless of the economy, stable performers.
Got it. Core U.S. markets plus some stable dividend and ESG flavor. That's the 60%. Next up. High-risk assets. This is the smaller growth-focused part.
Right. For the balanced profile, this is 15%. This is where you're aiming for higher capital growth. You've got funds like VUG for growth stocks in general, averaged 18% over 5 years, apparently. VGT for U.S. tech, specifically AI, robotics, space tech, that averaged 21% over 5 years.
Wow, strong historical performance there. What else?
Semiconductors. Big focus here, using an ETF like SMH, tracks about 25 big names, including TSMC, ASML. But there's a caution. It's a cyclical industry. Big swings.
Cyclical meaning?
Meaning its fortunes are tied very closely to the overall economic cycle, boom and bust. Plus, valuations are high right now, average PE ratio around 40. Investors are paying a lot for expected future growth.
So potentially higher reward, but definitely higher risk if growth slows.
Exactly. And then the very top of the risk pyramid in this section.
Cryptocurrencies.
Yep, Bitcoin and Ethereum specifically. Tiny allocation, though, treated purely as a hedge. A bet on decentralization, maybe against the dollar long term. But the source is very clear. Only use spare money here, money you can truly afford to lose entirely.
Okay, high risk, potentially high reward, but handle with extreme care.
Absolutely. If that whole decentralization idea doesn't resonate, you just skip it.
Right, so that's ordinary, 60%, and high risk, 15%. The remaining 25% must be the safety net, defensive assets.
That's it. 25% focused on capital preservation and hedging against stock market drops. Number 1 here is gold. Classic inflation hedge, currency hedge. You could hold physical gold or just use an ETF like GLD for convenience. There's a small management fee, like 0.4%.
Gold for stability. What else?
Bonds, but specifically short-term U.S. Treasury bonds, represented by VGSH, for example, maturity of 1-3 years, currently yielding around 4.3%. Key thing is they tend to move inversely to stocks. So when stocks fall, these often hold up or rise. Direct hedge.
And high liquidity, I assume. Easy to sell if needed?
Very liquid. So gold and short-term government bonds make up that 25% defensive slice. Risk control.
Okay, let's recap the balanced allocation for 2025 then. 60% ordinary risk, broad U.S. stocks, staples, 15% high risk, growth, tech, semis, tiny crypto, and 25% defensive, gold, short-term treasuries. So for someone listening, what are the final key takeaways? The warnings?
Well, first, the when to start question. With DCA, the answer is basically anytime. Don't wait for the perfect moment. Just start. Tomorrow, even.
But it's not just a recipe book, right? There are some big warnings.
Huge ones. Crucial. Number 1, don't just blindly copy this list. Markets change fast. That macro adjustment for bonds this year, that shows things evolve. You have to understand why the assets are chosen. Do your own homework. It's your money.
Independent thought is key. And the second warning. About expectations.
Yeah, manage your expectations. This portfolio is built for risk spreading and diversification. It's not designed to beat the market every single year or compete with someone who went all in on one hot stock.
Like, say, Palantir last year, which just exploded.
Exactly. This portfolio, with its bonds and gold, intentionally dampens volatility. It controls risk. That's its strength. But it means you likely won't capture those massive single stock gains. The advice is clear. Start diversified. Build discipline. Then maybe, if you really learn how to analyze individual companies, read reports, understand valuation, maybe then consider individual stocks. But start safe.
That makes a lot of sense. Build the foundation first. Okay, this has been a fantastic deep dive. We've covered the system DCA for entry, rebalancing for discipline, and the 2025 specifics, including that key macro adjustment reducing bond exposure and tailoring risk by age.
It really lays out a clear path for someone wanting a structured long-term approach without needing to be a market guru.
Definitely. So a final thought for our listeners to chew on.
I think it comes back to that core trade-off. The source says the main goal is to vigorously control risk. Yeah. So the question for you, the listener, is what are you really willing to give up for that peace of mind? This system offers consistency and aims to help you sleep at night. But it likely means sacrificing the chance, however small, of those extreme life-changing gains from a single lucky bet. What's that stability truly worth to you? That's the personal equation you need to solve.